Have you ever wondered why so many people seem to buy stocks when everyone is excited, only to sell them after the market has already crashed? If you've ever looked back at an investment decision and thought, "What was I thinking?" then today's conversation is for you. Welcome back to the podcast. Today, we're exploring a topic that quietly costs investors billions every year: how emotions affect market timing. Joining us is a renowned expert in behavioral finance, investor psychology, and decision science. Their work focuses on why our brains often become our biggest obstacle to building wealth, and how understanding those patterns can transform the way we invest. So let me ask you this. Why do intelligent people repeatedly mistime the market, and what role do emotions really play in those decisions?
It's one of the greatest paradoxes in investing. Most people believe successful investing is about intelligence, but it's usually about emotional discipline. The market doesn't test your IQ nearly as much as it tests your ability to stay calm when everything around you is screaming to do the opposite. Imagine standing in a supermarket. One day your favorite product is discounted by 50%, yet instead of celebrating, everyone panics because they think something must be wrong. That's exactly how many investors behave. When stocks go on sale, fear convinces them to run away. When prices become expensive, excitement convinces them they're finally safe to buy. Our brains evolved for survival, not investing. Thousands of years ago, following the crowd kept us alive. In today's financial markets, that same instinct can quietly destroy long-term wealth. When everyone around us is making money, the brain releases dopamine, that feel-good chemical that fuels excitement and confidence. Suddenly, buying feels less like a decision and more like an emotional necessity. That's why people often enter the market near its peak. Then the cycle flips. Markets fall, headlines predict disaster, social media amplifies panic, and cortisol, the body's stress hormone, takes over. Rational thinking fades. Investors stop asking, "What is this company worth?" and start asking, "How quickly can I get out?" Ironically, that's often when the greatest opportunities begin to appear. History keeps repeating this lesson. During the dot-com bubble, many investors believed technology stocks could only go higher. In 2008, fear convinced countless people that recovery was impossible. In both cases, emotions, not facts, drove many decisions. The same story has played out in nearly every major market cycle because human psychology hasn't changed. Another powerful force is loss aversion. Losing $1,000 feels far more painful than gaining $1,000 feels rewarding. That emotional imbalance pushes people to make short-term decisions that undermine long-term goals. Add confirmation bias, where we only seek information that agrees with what we already believe, and suddenly we're no longer investing, we're simply defending our emotions. So how do you fight back? Start by accepting that emotions never disappear. Even experienced investors feel fear and greed. The difference is they build systems that prevent emotions from making the final decision. They invest consistently, follow a written plan, diversify wisely, and remember that market volatility is not the same as permanent loss. They understand that patience isn't passive, it's a competitive advantage. One thought has guided generations of successful investors. The market transfers wealth from the impatient to the patient. When you stop trying to predict every twist and turn and instead focus on disciplined long-term investing, something remarkable happens. The market becomes less of an emotional roller coaster and more of a wealth-building partner. Because in the end, the biggest battle in investing isn't against the market, it's against the voice in your own head. Master that, and you've already won half the game.
What a powerful reminder. The market isn't just a place where money changes hands, it's where emotions are constantly put to the test. If today's conversation helped you see investing from a new perspective, don't keep it to yourself. Share this episode with someone who could benefit from it. Subscribe for more insights into the psychology of investing. And remember, the investors who build lasting wealth aren't the ones who predict every market move, they're the ones who master themselves. We'll see you in the next episode.